IVM.
There are two problems in insurance. One is, Anupam, if I ask you also, for that matter, to say whether you have insurance, I'm sure you would. But the problem with the urban is whether they have enough. So the question for the urban people is whether you have enough, because nobody assesses, at what point of time something unfortunate can happen, and therefore what is the need for what he or she will leave behind. Whereas the rural is the issue of coverage. So I think the opportunity and whatever you are asking for is both in terms of urban and rural. But today the urban coverage is reasonably good from number terms, but still value is, I think, underpenetrated. And rural, I think, is a combination of both. You've got to remember that when you compare a ULIP with, say, a mutual fund, which is a comparison that people make, and a fair comparison to make, except the fact that for the premium that you pay, if you get 10 times of that as a coverage, if something unfortunate happens to you, doesn't exist in any of the products. And therefore, there is a mortality related cost. And therefore, this whole debate to say whether is a life insurance ULIP costly, because finally, if you're saying you're paying 1 lakh rupees premium and something happens to you in the second year or third year where you paid 3 lakhs, the company still pays you 10 lakh rupees back. From an investment point of view, the return looks large, which has to be covered through a mortality cost that you build in into the product. If you are a long-term investor, the costs of a ULIP actually break even in about year 6 or year 7 and becomes comparable to a mutual fund. And then I can only tell you that long investing, if you stay invested long, whether it is you do that in the mutual fund, you stay in the market, or you do it through the ULIP product, the returns of those products will beat any short-term fund manager hollow. If you are in the business of life insurance, people think you are in the business of paying money when death occurs. Okay. Uh-huh. But statistically, I will tell you, out of every 100 rupees that gets paid by all life insurance companies as an industry, 11 rupees is paid for death.
Wow.
89 rupees is actually paid to people back who are living.
Okay. It's a very interesting statistic.
Which is fundamentally saying that we have now moved or wanting to become a investment asset class as compared to a protection asset class.
Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta, B50 on Twitter, and in today's episode, I'm talking life insurance with Kamlesh Rao, MD and CEO, Aditya Birla Sun Life Insurance. We're going to talk about life insurance, ULIPs, investment products, and a whole lot more right after the short break. And welcome back. Kamlesh, welcome to Paisa Vaisa. Thank you so much for doing this for our listeners.
My pleasure.
I'm thrilled to have Aditya Birla Sun Life Insurance for the very first time. I figured we've been doing this for 6-7 years and never had them. So great to have you here. Let's start with the broader life insurance industry. It's now more than 20 years old from the time that you had private insurers set up their base out here. How has life insurance coverage improved in these 20 years or in the last 5 years or whatever? How has the industry performed? I think from both perspectives, from the customer's perspective, providing insurance, as well as for the insurance from an industry perspective.
So normally coverage of insurance is measured either by what they call insurance penetration or insurance density. And there were two phases for insurance. Between 2001 and 2010, I think it had a big run where penetration went all the way up to about 4.5%. And then there came a period between 2010 and 2016 because regulations changed at that point of time, which saw it go back all the way down to again about 2%. And between 2016 and now, which is 2023, it's getting the climb all over again. And as I speak to you, penetration levels would be roughly back to about 3.5-4% right now, which is still small for the size of the population that we have. And density, which is basically the dollar value of saying what insurance penetration is. Again, started very low at about $10-12, went all the way up to about $60-65, came down again during that period, and is back to again about $70-80 in Indian context. Still, there is a dollar connotation here, but I think it's the most underpenetrated industry today. And my sense is if you look at the growth of the life insurance companies over the last 6-7 years, it is one industry which has grown at about 13 to 14% CAGR for the last 7 years. So I think we have lots of coverage to do, but I think it's the bright spot for financial services and life insurance.
Just to understand statistics a little bit better, when you say 3.5 to 4%, what's the numerator, what's the denominator?
So in penetration, the numerator is coverage.
Right.
and that's percentages of the GDP. So they look at the percentage of the GDP.
Premium as
Whereas
compared to-
in the second density, they look at the premium and they compare it with the population size. So that's the difference between the density and penetration.
We've got a long way to go, basically.
Very long way to go, and I think a very hopeful long journey for life insurance.
And generally, I think I'm guessing that if I were to divide this between urban and semi-urban, rural, urban coverage is pretty much tapped out, or is there still scope there? Because I'm guessing that semi-urban and rural has a much wider scope.
So I think I keep saying this.
Very interesting point. We'll get to how to choose a life insurance product later on the episode, folks. It's a very important point that you should also be considering. Okay, now moving to the more investment-related products, popularly ULIP. I think last 2 years, every year there's been something in the union budget. I don't know whether to call it plugging a loophole or whatever it is. So how has this segment performed? What were the two changes that happened and what's been happening there?
This is something that we keep debating to say, and I've been part of the investment world across all products.
I mean, you'll have a better idea about this
whether it's
loophole and
mutual
comparing it to
fund,
both
or
sides.
mutual
Yeah,
fund,
wonderful
whether it's
perspective.
direct equity, whether it is insurance. And therefore, if you look at a ULIP, and I
interesting.
wouldn't take credit only for the fund manager for that. The beauty is the fact that you have stayed invested for 7 years. Whether it is any asset class, my sense is if you stay invested for a longer period of time. With ULIP, fortunately, in the earlier part, the cost looks higher, but you get mortality cover. If something happens to you, you get that. Towards the latter half, the costs become even as compared to any investment. And of course, you get a significantly better return. The fact that there is a tax benefit on ULIP was what got changed.
Exactly.
But fortunately, it still got considered as a capital asset. And therefore, LTCG got applicable above a particular value. So investments of about 2.5 lakhs now in ULIP are subject to long-term capital gains.
So I'll just hold you there. So you said if my ULIP premium per year is more than 2.5 lakhs, then the time when this ULIP matures or whatever, it could be a death, it could be whatever it is, then at that point of time in the future, whenever that is, then that sum that is paid out to me will be taxed in capital gains. Did I understand that right?
Yeah, except that death benefit is not taxable.
Okay.
So anything that you get in an insurance product today out of a death benefit, that is still not taxable.
Right.
If you get fund value back, again, I don't know whether you ever wonder what business are we in, and I try and define that to say people have this constant debate whether I should put money in mutual fund
Exactly.
and I should take a protection cover. But the money paid by life insurance companies for death is only 11 rupees out of the 100 rupees that it pays off every year. And 89 rupees is actually paid for people who are living.
So what you're saying indirectly or probably directly is that the job of an insurance company is to invest all the premiums they get into reasonably good investment products so that, you have a strong balance sheet, you can pay out whenever it's required.
Reasonably good, and I think the key is long term.
Yeah.
I keep saying this, that my asset managers are boring. Okay?
Yeah.
Fund managers are boring. Because for the fund managers, the objective is very clear. I have committed a benefit to my customer. I have to take care of that benefit. And therefore, even if I am not in and out every year or every 3 months or 6 months, because fundamentally an insurance product is supposed to take care of the customer paying me money for 8-10 years, then waits for a particular period of time and expects me to pay that over the next 30-40 years. So our horizons are very, very long term. And that, I think, makes a big difference from an overall investment strategy point of view.
I want to go down that in a little bit more of detail because I think that's the nuance that a lot of people miss when they do this mutual fund versus insurance. We'll just circle back to that later. But flows generally after the tax changes have been, they've held up, right? It's not, or have you seen some changes?
So the industry after 1st April of this year is growing at about 13-14%. But to be fair, I think the real upside that some of us got as an industry was in the month of February and March.
Right.
So if I give you the same number sitting here in April of next year, then there wouldn't be a difference.
That's the base effect. Yeah.
That's the base effect.
Yeah. Okay, so there's a very interesting article that you wrote in Economic Times about life insurance driving inclusive growth in rural India. That's something that anybody would want, inclusive growth in rural India. Can you just recap that for our listeners? And especially because there's this part out there where you said about how life insurance can empower women. You just spend some time on that because I think that's an important point that probably gets missed in a lot of conversations.
Like I said, India is like India and then there is a Bharat. Okay. And like I said before, maybe the problem in Bharat part of India is both the coverage as well as the size. Urban at least penetration is fair, but maybe only the value is a big problem. So if you look at the regulator today, who has a dream to say by 2047 there should be insurance for all, we have a very pragmatic regulator since the last 1.5, 2 years time, pushing what I call what is right to be done from a insurance penetration point of view. You'd be surprised, we are trying to create products which are common across, cutting across all life, general and health insurance companies to say, can we provide people a minimum coverage on health, life, property through a single product, which is not created by individual companies, which is created by all of us together. And that is what we use to make sure we can increase the penetration in the rural area. Then we say, how should this get distributed? Okay, and that is where women, come in, because I think rural India, I have this thing that we are maybe equal in terms of population. I'm told last statistics, women have a few notches above men right now in terms of population, but that's not true when we look at either different levels of women in companies. As it keeps going up, I think that percentage keeps coming down. So we looked at an interesting project on Asha workers to say, if we create a product like this and we create the entire distribution channel through what we call it Bima Vahaks. It's called the Bima Trinity right now. If we can do that, you could have a great product which could take care of rural penetration and also distributed by people of the right kind. My sense is, I don't know, we keep thinking that, the men who go out to earn, and of course today it's no longer the same because women are equally going out and earning. But I think the prudence on balance, the prudence on risk management, or the perception that is understood well on the other side, because they manage expenses of the house even if they're not working, and that's like managing a P&L of its own kind. So we are saying, can we create products like this for rural and also use the channel of a very different kind, which will empower both women from distribution point of view as well as the consumption from a rural point of view. That was the focal point of my article.
Have you got a product like that? And the reason, I'll tell you why I'm asking, right? Because insurance life insurance as a concept is about replacement of income, okay, to the primary owner of the family, that in case, God forbid, if he passes away, then the family can. But women don't have any insurance cover because they don't have any quote unquote earning capacity, okay, which I personally find slightly off. But what can I do? I'm nobody. You're someone from the industry. How does this work, and how does this, how is there a solution, or am I asking the wrong question?
No, but what you're saying may not be fully true in terms of data, because we still have roughly for the industry about 26 to 27% of the policyholders are women. Now you can argue whether it is bought by the man in the name of the woman or bought by the woman in the name of the woman, and we don't have those statistics, but it is bought in the name.
As long as within the family there is one.
But it is still not as high. I don't think, we've thought through of what is the right product for a woman. You said, for a man it is about replacement of income. Now, why I keep saying that we pay only 11 rupees for death and 89 rupees for people living is because in India from 2025 to 26 onwards, the aging population who will retire is doubling every year.
Oh, people don't realize that.
People
don't. When they do,
and when they do, what will they do to be able to keep their life going for? And we have beautiful products as an industry on annuity. So you start saving from 45, 50, build something till 60, wait for some time and get that money. That's what we pay for.
Make people understand annuities, and I would, really put my hat up for you for their.
Yeah, but that is today 6% of life insurance business. It used to be 2% 2 years back. And if you ask me this question 3 years from now, my sense is it will become 20%.
Yeah, I mean.
So that's the rate at which some of these products are growing. Yeah. What we haven't cracked, maybe, we do products for women. But I think an ideal product for a woman is to say in India, and I'm not being a male chauvinist here, but to say there will be points of time where a woman will take a break. Whether it is for getting a family, whether it is for different reasons. We don't have a product which can replace her income at that point of time. If you can have a product which says you have a product for insurance, and then whenever you decide to take that break in your period for 4 years, 5 years, and then you want to get back, we'll protect your income for that period, and then you can come back and then you'll get protection. At Aditya Birla, we're trying to price a product like that, but I must admit I have taken 6 months but still haven't come with one. But when I come with one, I'll come back to you and talk about it.
I'll wait for you to come back on the show for that. Kamlesh, what's your outlook for the insurance industry? I mean, you're saying that you're going at about 13-14% per year for the industry. How do you see this in the next 5-10 years? We just spoke about two things which I think are not either understood properly or appreciated properly. A, the large aging population that we have, which will in a few years, if not already, cause certain issues for us, and B, annuities. But other than these two, anything else you want to say about the outlook going forward from here?
So my sense is I'm very bullish because size of penetration is very low. I think insurances and awareness has picked up significantly. Last 3-4 years, for the kind of products that the industry has created, even affluent people are looking at an allocation to insurance in their asset pool. It's like this, if I'm paying products today which give you say 6% return, okay, 6% or range bound 6% return, adjusted for tax, it becomes about 9.5%. And you are guaranteed that income for the next 30 or 40 years time. Now you have to have a view to say 30, 40 years from time, when India becomes what it will be, the way we are going, what will the interest rates in India be? I don't know. If it is anywhere close to what the interest rates were in the US and Europe about 2 years back at 2% or 2.5%, then insurance is a product in which you are also getting a benefit what you are guaranteed today for the next 30, 40 years kind of time frame. 30% of insurance business today happens in this product category, where people are locking in and saying, maybe the interest rate is good, I want to lock the return over the next period of time. Keeping that in mind, I think 13-14% growth or slightly higher than that is sustainable for the life insurance industry, according to me, for the next 5 to 10 years time frame. And that, I think, is the size of the opportunity for the life insurance industry.
Products, you think anything new is going to come up out there, or anything that's undiscovered, untapped from an industry's perspective towards the consumers? You think there's anything new that you're looking forward to that could change?
So you covered that. To say annuity is one big piece that we are seeing. B is, when do you buy insurance? The problem with the Indian context market is, a guy thinks when he gets older he should buy insurance, when the irony is that the price for which you get the insurance when you are younger is significantly cheaper when you become older. That realization has come in health ever since COVID has happened, because COVID didn't spare anybody, right? Whether you were 20, 30, 40 or 50, it didn't matter. I think from health to wellness, people are getting conscious about. The fact that people will buy it earlier, I think, is a very large market, because I think average age of which insurance is sold today is still, the biggest tipping point starts from 36, 37. But my sense is it should start from about 27, 28. And that is a very, very large segment for India in that sense. So as it keeps coming down with the insurance awareness going up, I coincidentally happen to be the chair of the Insurance Awareness Council, which we've just created, which is similar to, hopefully we'll start doing work like the mutual fund Sahi Hai in the next 2 or 3 months time frame. We have it in some form. We did some work in the past, but I've just taken over as the chair. We are hoping to do some interesting work over the next 3-4 years time to broaden the category of insurance, what it means, why not annuity, why is it an investment product as much as it can be a protection product. We're going to spend a lot of time and money in this area, and I'm hoping as we do that, the penetration for us will even be better.
But what random logic is this? You're saying that at 27 someone will start an SIP but not buy life insurance. That doesn't make any sense to me. Is it an awareness problem or what? And this is the point that I very strongly believe that, and I get this from a lot of people, saying that what's a good SIP, what's a good mutual fund, and I mean, do you even have life insurance and health insurance? Have you ever thought about those as basic financial products to start from before going into SIP? And I'm talking about a very retail audience, because when you said that the age is around about 36, and that's an average, I'm sure there'll be many on the lower side and many on the higher side. And like you said, it should ideally start at 27. So I'm just trying to understand that. Am I understanding this?
It's not really. So I think having seen this cycle reasonably long, maybe at 27 you are more conscious about whether I'm going to buy my first house, whether I'm going to get my next car. Okay, and therefore when you look at the final economics that you have, and therefore you say this is my EMI, and therefore I should still save some money. When the quantum of the money is lesser, I don't know whether the allocation happens. That may be a great time to buy your first protection product.
Okay.
Because that is the time you will get it the cheapest. In India what happens is whether you buy it at 27, you buy it cheaper, you buy it at 37, you buy it costlier, at 47, God bless you, if you are able to get the product in the first place. But once you buy it at 27, your price for the insurance that you have got does not change. Through the end of the period. Okay.
Imagine that.
So if there are two 27-year-old guys, one will become healthier, one will not remain healthy, but it is the price because you're 27, you get it. And that's how the products are structured at this point of time. So therefore, buying something which is more important for you earlier is important. And as your investable surplus keeps going up at say maybe 30, maybe not 27, at 30, when you buy a house, do you buy an insurance? Because God forbid if something happens to you, somebody has to pay your loan.
Yeah, thankfully, okay? I think home finance companies insist on
If they insist, so that is your first form of insurance that you bought because it is provided by the insurance company itself. I think if we get those elements in on a larger basis, as your surplus keeps going up, then you start looking at some of the products that we provide on investment category, and then they are comparable whether you want to do some asset allocation. We are only saying right now that whenever you get the asset allocation worthwhile doing, insurance is knocking at 10 to 15% of that, and that is what you should look at different points in time.
So folks, my message is while you're considering a lot of investment products, please do get your insurance into place, whether it's health, whether it's life. You would agree with that, I hope.
Kamlesh. Yes.
Do consider those products, which we're going to talk about right after this short break. And welcome back. Okay, Kamlesh, now let's talk about specific products and, strategies and stuff within insurance. We gave some thought to this whole insurance as investment thing in the first half of this episode. Let's just drill down deeper, especially, and I don't usually get guests who've been in such varied fields prior to coming into insurance as you are. We spoke about, before we started the recording, we spoke about how you spend time in banking, you spend time in wealth. So you've seen a wide variety of customers. You've also seen a transition of India happening with this, I would say, boom in awareness of financial products and this entire debate about how you should not mix insurance and investment. Can you just go further here and answer this, that what do people get wrong in this debate of saying that never mix insurance with investment? What do they get wrong?
So people get this idea to say, I would make my return on an investment product and I would secure my mortality through an insurance product. And I often ask them, why is it not making sense for one to do both? And obviously, it's not a replaceable product. It's basically what is the kind of allocation that you'd want to make. For example, if you put money in a bank fixed deposit, you genuinely need to put it because you require liquidity. Now you compare your rates and the tax efficiency of an insurance product that gives you the same return or slightly better and adjusted for tax is significantly better and gives you 10 times life cover. You'll have to park and say, of my 100 rupees, if I am able to invest 20 rupees, maybe there is a 2 rupees out of that which does not require to be liquid. And therefore, can I lock it for a longer period of time? The reason I'm saying longer period of time, because as you stand today, there have been points of time where India's GSEC rate has been 7. There are points where it went all the way down to about 5.8, 5.9. It's come back to 7 at this point of time. India has already become a 4 trillion economy. I don't know where we will reach 20 years from now. 20 years from now, if you're a $10 trillion plus economy, any economy of that kind had interest rates of 2% at different points in time. Your money will at that point of time earn 2%. If you invest today and lock it on a guaranteed product which say insurance companies offer, today's return is 6%. Adjusted for tax, it is 9%. You will have some portfolio for yours which will earn that same rate over a period of time. Annuity. If you look at the IRR of the product, you may argue and say, oh, this is making only 6 or 7% IRR. If it makes 6-7% IRR, again adjusted for tax, annuity is taxable, partially taxable, all that we know. But the fact is you need a stream of income to come to you without fail, keeping your lifestyle in mind today. Therefore, do you need to keep some corpus of yours when you turn 45 to say, hey, I need to plan for what will happen to me after 60. Somebody will argue and say, I can put the same money in equity. And over 15 years time, it obviously has got to give you a good return. You don't know which is your period of that 15 years. Because in a 15 years time, you will see a peak, you will see a mid and you will see a trough. Okay. The problem with that is when the trough comes, what do you do? At that point of time, you don't have an answer, right? If you are ready to wait and if you have so much surplus that trough does not bother you for the next 1.5 years, because the trough normally takes that much time to go away. All we are saying is that trough for you to manage, you will need to have a part of your portfolio which will still give you something consistent, which may give you adjusted at 9, when maybe the equity gives you 14-15%. But that's what you are adjusting for, right? That 9 is assured for 30-40 years. That 15-16 will come for 5 out of the 10 years and 5 out of the 10 years it may not come. So you have a mix of both. It's like saying don't put all your, whatever famous thing we learn, eggs in one basket. Yeah. Therefore, the need to have an allocation of asset class for insurance.
Yeah, and the pushback that I normally get when this is, and you would appreciate this more because you've been on the other side with investment products also, is that just take a debt mutual fund and just, take a pure risk cover, which is much cheaper, take a debt mutual fund and just do an SWP or something. Do you have any thoughts on that?
So it's for a classical investor, it's a great combination to say, let me do the mutual fund on this and let me just buy the death cover. The reality is when you do that, the death cover is not yielding you anything. Because there are times of period of time where you say, I paid that premium for 20 years, if nothing happened to you, that premium is gone.
Yeah.
You have got no return on that premium. Now, when you combine that 100 rupees which you split this way into 80 and 20 and say this 20 gave you no return, and on the portfolio together, if you had to combine that 100 rupees together and then thought of insurance as an asset class which gave you for the same period the same return as a fund, because if you have a long-term horizon, the risk cover, the death cover paid for itself.
Yeah.
So, I mean, there's nothing called right or wrong in the process, because if you are a very prudent investor, you will find that final dot between that 1% and 2%. My belief as somebody who's been a guardian of people's money in various roles that I have performed is to say, do what is right, but don't do everything in one place. And therefore, if you have 10 rupees, the brightest guy is the guy who allocates that 10 rupees across various categories and not the guy. But the problem is we get all examples of the guy who put that 10 rupees in that one class, because when he makes the 500 rupees, it's like startups, right? We only hear of the one that has become a unicorn. We don't hear of the 99 who have, burnt their way out completely.
Yeah.
And the 99 is where the retail is. One is just one outstanding guy standing out. So from that point of view, just don't get the 10 in one place and say it will make a great return. Maybe use that 10 ka 1.5 in different asset classes. All have their pros and cons and all have the returns that they make at different points.
Yeah, and we'll go into those products soon. Kamlesh, what are niche term insurance plans? You've got something out there, just talk about that with us.
When I came to this industry and COVID happened post that, and then prices went up, and suddenly today, 2 years back, if you were to buy a term plan, today is, according to me, at least double the cost you pay because of the mortality that has happened post-COVID and so on and so forth. So we kept looking at niches to say, can we do something differently? Okay. So we say, rather than postponing your term plan, buy it for a shorter period of time. Just buy it for the next 5 years. And a lot of people argue and say, term you should never buy for the next 5 years. For the guys who buy term, they always buy it for till they reach 80. Yeah. The problem is for the guys who don't buy and keep postponing it. So there was a product created for that to say, don't postpone it. At least make sure you buy it short term. You pay significantly lesser money. That product was whatever, 40-50% cheaper than a normal term plan. Then we said, can we create a category of people? And today there is data available to say whether you are a salaried customer, whether you are a self-employed customer, which bracket of income you are in. And depending on which bracket of income you are in, your mortality rates are different. Now, this is not my data. Data comes from all the people who own the data, whether it is CIBIL, whether it is the actuarial, and so on and so forth. So we found an opportunity to say, for the salaried customers, maybe we can create a differentiated product. So today we have a product meant for salaried customers, meant for their age of their work. Normal retirement is 60, 65, or 70, so till 70. And it by far is a very differentiated product meant only for salaried customers, and because the mortality rates are different, we are able to price it and make it efficient for the salaried customers.
Okay. Now let's talk about this portfolio of investment products in life insurance, and a portfolio approach. Maybe before we go into that, maybe you want to just introduce what are the investment products within life insurance, because I'm a stock markets guy, so I often get confused between the terminologies out there. There's something called savings plan, there's something called ULIP, both are not the same, by the way. There's annuities, there's pension plans. So just on a more simpler.
So broadly there are 4 categories. Okay. One is the pure term product. Okay. So a term in the past used to be you pay the premium, something happens to you, get the money, nothing, it goes away. Yeah. Today there are variants to it. Today there are variants which says, okay, you want to pay a little higher. If nothing happens to you at the end of the period, you can actually get all your premium back. Okay, but no return. You get your premiums back. Again, better than the first one, but not a great investment product from that point of view. Sure. Then you get a category of what you call non-par products, par products, and ULIP products. So broadly, there are 4 categories. I spoke about term. What does non-par mean? Basically is where you get guarantees, which means today if you put money and there is a product which is assuring you of a 6% or 6.5% return, which I can afford to pay you today, I am actually telling you for the next 30, 40 years of your policy term, that is guaranteed to you. So I think if you are looking at security, if you're looking at interest rate arbitrage over a period of time, and we are talking about 30, 40 years, then that's a great investment product to do. Where the benefit is that you paid the money, you know exactly what you are going to get. So we have a product which is called Nishchit Ayush, which says, you give me 1 lakh rupees, I'll pay you pay me 1 lakh rupees for say 10 years, I will pay you 38,000 rupees for the next 40 years. But that money will start from next year onwards, Okay, so there are people who are now saying, okay, I'll give you this 1 lakh rupees for 10 years. You will give me this return on a yearly basis. I will take that money and go and pay my EMI, or I'll take that money and put that into ULIP of a mutual fund. I'll take that money and keep buying gold every year of that quantum. So what they are doing is, of a product that is giving me a 5.5-6% return tax free, I am using the returns of the money into another asset class and building my corpus of portfolio. But the beauty of this product is, what I am telling you I will pay, which is that 38,000 or whatever, depending on what premium you pay, is guaranteed, assured for the next 40 years time frame. Okay. Then there is something called a participating product, which basically means that there is no guarantee there. I will invest your money on a significant long-term basis, but this is what people do for accumulating wealth. They don't want any money till the next 40 years. Okay, I want money at the end of the 40-year period. Companies are supposed to declare their bonus every year. By and large, money here goes into debt instruments. You create a corpus, but the power is of compounding. You declare your bonus every year, which is what I am mandated to do. But you keep accumulating that bonus over a period of time and get money after 30 or 40 years time. So these are called participating products. And the last one is market-linked product, which is called ULIP, which you spoke about in the beginning, where you have a choice whether you want to take this money into an equity fund that I invest in, a debt fund that I invest in, a balance fund that I invest in. And during different points of time, if you are a prudent investor, you can keep moving your money across these funds, and there is no tax implication on this. So that's the benefit in a ULIP. But my advice to people in ULIP has always been like that. If you are a short-term guy, if you want to look at a 1-2 year horizon, put money in mutual fund. Okay, it makes a lot of sense. Because the cost of ULIP in the first 2-3 years is high, because I have to price the fact that somebody will die in those 2-3 years. And I have to pay 10 times of the money, because unless I pay 10 times of money, it doesn't become tax free. That is the 10-10D requirement, that you have to make it 10 times, now 7 times, and so on and so forth. So that is a market product where you are taking in the risk with me. You are taking the cover also at the point of time. But I think for anybody who has invested on average 10-year basis, wouldn't have realized a return of less than 12 to 14%.
Wow, tax-free.
Yeah.
Very interesting. So, okay, let me just recap that. So there's pure life, of course, with its own variations. You've got non-par, which is non-participating.
But guaranteed,
obviously. And you've got participating, and then you've got ULIPs. Have I understood
yes,
correctly?
These are 4 broad categories.
Yeah.
And the annuity that you spoke about is part of the subcategory of the non-par product, is the annuity product. Yeah. That's how it works.
So what do you think is a portfolio approach to these products? Like if I'm someone who's now that you've told me about these very, very different products, and what is a portfolio way to, to incorporate these products into our personal finances?
So I wouldn't really comment on, say, my sense is if you have 100 rupees of investable surplus, my sense is insurance should feature in about 15-20% of that portfolio. So I'll talk about those 20 rupees.
Please. Yeah.
In that 20 rupees, you can't be without having protection. Okay, so I think that is the foremost, and that is very cheap. I'm saying for cost that you pay is very cheap. Then you do the same thing that you do in investment. You look at the risk profile of the customer. Okay, so if you are a very conservative guy, then I'm saying it makes more sense for you to have an allocation in non-par, because you are like a fixed deposit customer. You know the return. You know exactly what you are getting. You know you are getting that for the next 40 years kind of time frame. So if you're a conservative guy, you happen to be there. If you are not a conservative guy, but you are a balanced or an aggressive kind of a guy, then you move to ULIP, because you get the advantage of saying you participate in the market, whether through, and depending on how aggressive you are, you can go fully into equity, fully into debt, or somewhere into balance in the middle, where you can enjoy both the market upside also, and you can enjoy your inbuilt protection that you get. But like I keep saying, if you are in ULIP, you have to be in it for 10 years time frame. Obviously. If you have that time frame, I think it's a great product to be in.
Yeah. Last question, how has the industry evolved, from its heydays when it started off? It used to have very high upfront commission, which was abused, misused, whatever. IRDA also then woke up and aligned everything. From there to now, where awareness also has grown for a lot of people, where do you think the industry now is for those very, I would say, dicey points like mis-selling, like having hidden costs, and people just waking up to the fact that, oh, I didn't realize this. Where are we now on that? Do you think that it's become more customer friendly? Is there more work to be done, etc., etc.?
I think I'd say there is more work to be done for sure. Let me begin with work that we need to do. But if you look at data over the last 2016 to 2023, you will see every year starting from where we were in terms of complaints per 10,000 policies that we have for the industry, it has only come down in the last 7 years time frame. Okay. And why has it come down? I'll give you examples. What is the the way the industry has grown over the last 7 years, there have been more bank customers who have bought insurance than non-bank customers. Okay, at one point of time, the distribution channel, which was large, used to be agents. They used to control 65% of the market. When banks started, they used to be at 35% of the market. Today, if I go back to last year's data, the banks will be 63% of the market, and the agents and advisors will be 38% of the market. Now, you please understand, when banks are selling to their customers, okay, the things that they build in to make sure they are doing the right sale. And bulk of the banks are on open architecture right now, which basically means they are distributing multiple insurance companies. The customer has a choice because you go to, say, my largest partner, HDFC Bank. He distributes both HDFC Life, he'll distribute Tata product, he'll distribute a Birla product. Which means the customer has a choice. He chooses between us what is the better product that he wants. Then what we do for bank customers is, because banks have data, so they know Anupam is a customer, he knows your profile, he knows your transaction history. Today, data models have reached a stage where we do work with HDFC Bank today, where we say, this is my model. We actually realize that out of every 10 customers, there are only 6 customers that we should sell insurance to. 4, we should not sell insurance. So basically, the category of people who should not sell insurance is now getting eliminated out of data. So the 6 gets sold. Then in the 6, based on the data that the bank has, because bank doesn't share data, it puts my model on his base of customers of his own model and arrives at an output. He knows what is the product that should be sold to the guy. So he tells everybody who is selling that if you are selling to Anupam, you can sell only these 2 products. Right. Because data now tells me that these 2 are the best products to be sold to Anupam, basis his profile, risk profile, transaction, history that he has with the bank, and so on and so forth. We do about 30 to 32% of our business only out of these data models right now with banks. Okay, which means I'm talking about 1,000 crores a year types. Yeah. Our complaint ratio in this portfolio for the last 3 years is 0. And thanks to COVID, and we must thank COVID for, of course, it did a lot of bad stuff, but it did a lot of good stuff also. Entire communication now of sale is digital. So there are no papers in which I am selling you. I am sending you my product feature. So there is nothing that I told you or I did not tell you. Look at the verification processes today. Okay, first it used to be like saying, कि मैंने आपको product बेचा. Now I am calling you and telling you, अच्छा, are you sure you bought the right product? Now I don't know whether somebody is standing next to you and telling you, हाँ बोल दे, at this point of time. Today our verification methods are based on video, which means the customer is saying what he thinks he bought. And that is my process, which is embedded to make sure that my sale is right or no. Wow. We are now moving to another model which says, when you are doing the recording, your facial expression tells me whether you understood the product well or no. Okay, there is a technology which will be able to tell you that. It's like saying today, facial expressions tell you even your BMI. I can tell you whether you have BP or sugar for that matter. So at least when you are saying what you have bought, the technology now tells me based on facial expressions that this guy has understood it fully. Where we get a doubt, we put it to another contact center and say, call him again and say whether did he... Now these are stuff that the industry is doing, we are doing, which is actually bringing this whole concept of mis-selling or which is there. But do we need to do better? I'm saying we have still work to do. Yeah. But at least we are on that path. There is no paper today there is no form. Yeah. We don't have any application form. It's completely digital. Yeah. My prospecting is completely digital, which means you have a record of what I told you. Tomorrow I can't say I came and spoke to you and I said, this I misunderstood. Okay. Wow. Plus, like I said, when I do verification, we have video methodology of doing that right now. I think we've gone through a sea change and we must thank COVID for it for sure, because we've really leapfrogged digital in that process. We have to now make sure we clear claims also digitally. Okay, so and stuff like that is happening right now for the industry. But if you fast forward 3 years, my sense is, we will be in a significantly better shape than where we are, but we've progressed very, very well for the last 3 years.
What do you think the customer needs to do? In the sense that you've said everything about what the industry is doing from their side, these processes. What is your message for the listeners out here? How can they make smarter decisions? What are the maybe 2-3 areas where when they're taking an insurance policy, whichever, term, par, non-par, you live, what are the few things that they should, just pause and think? to avoid this risk of mis-selling and all that?
The first thing as a customer is tell your nominee that you bought a life insurance policy.
Come on, yaar. Seriously.
No.
People don't.
38% of the people who buy the life insurance policy don't tell the nominee because he thinks nothing is going to happen to him.
I don't even comment on
and
this.
when something happens to him, the nominee doesn't know that somebody has taken care of me by buying a policy in the first place. Okay? So we run a full nominee program. Okay, and so that's the first important thing I think that you need to make sure that you do. For a customer, I think it's very important to say he should buy a policy. And he should not get sold a policy. You know, I normally say this to my sales guys also very importantly, that finally you have to make sure the customer has bought it, which means you offer him a range. Okay, the customer should basically ask and say, if I just want pure investment, okay, then I should not go beyond my non-par and ULIP category. I should not talk about protection. But to say, if you buy a non-par product without having bought the protection product, I think you have to ask yourself to say, kaise karega? First make sure, unless you are happy with the cover that you have got only out of your investment policy. Because say finally if you pay 1 lakh rupees, it's a great investable surplus to put, it will give you 10 lakhs cover. Yeah. 10 times you will get. But 10 lakhs may not be good enough for replacement, right? So I'm saying from that point of view, if you've got your term right, then I'm saying you walk into the investable surplus method. But first, essentially try and make sure that you get the term right. Look at your third point is look at your insurance investment like any other investment that you look at. Problem is that, and we did this as a study to say 5.5 out of 10 guys did not know which company they had bought their insurance from.
Wow, 50%.
Yeah, so they said, I have insurance. Which company did you buy it from? 5.5 out of 10 people didn't know which company they bought it from. Which means they are not seeing how their investment is progressing. Okay. And if you are in a market product like ULIP, you want to watch it like you are watching your mutual fund. You want to make a switch because you bought it into equity and now you think the time is not right, you want to go to debt. You should be able to do that at different points in time. So I think if you do a combination of all these three things, I think it's absolutely
wonderful. Kamlesh, we are done with the main questions of our show, but our last question, standard question to all our guests, because and in fact, I have people even asking me now that, are you making a list of this? So what book are you reading, or any recommendation that you've got on the content for our listeners?
So I'm going to make you unhappy. I'm not a fond reader of books. Okay.
Whichever content. Out here, content is anything.
Basically, for me, content is. I keep saying that as you progress in life, you need to be able to make sure you can scan the environment pretty well. And I have a set of people who are just scanning what's happening in the outside world. Okay. Is there a better way to create your product? Is there a better way to execute your delivery of the product? For example, we learned this from one brilliant case to say, what do you do for a guy who dies? Okay. And somewhere in some part of the world, there was an example which says, plant a tree in his name. Okay. I just found that this gave me an insight which I would have not read through any book for that matter. Today, we have an option for all our term products, to our term insurance guys to say when something happens, you can actually plant a tree in the Sundarbans. You have a QR code. You can monitor the progress of the tree as it is progressing. And it is in the name of the person who has passed away.
And you'll take care of that.
And we will take care of it. Wow. Okay. Because it doesn't take much to take care of that. Yeah. But at least you have done something in the memory of a guy for... This whole thing of nominee came out of a study that was happened in some part of Japan.
Okay.
To say that, people don't know. And if you don't know, how do you claim? Because you have no idea that somebody has kept that money for you. Wow. I will come to know only when the premium is not being paid, right? But assuming you are a 10 PPT and 40-year policy, you paid your 10 premiums. Yeah. So then I don't have to bother about whether you paid or not paid. But in the 25th year, if something has gone wrong to you, so we have a nominee awareness program right now that we do.
Right.
The other things that I'm focused on reading is extremely on what is happening on artificial intelligence, what's happening on ChatGPT, what's happening on new technologies, because I realized that if I put all my content onto a private ChatGPT platform, there is no better tool to learn what you are doing so brilliantly yourself. Okay? Because what he reproduces is better than what a human being does. Then somebody told us that in some part of the world, when you are calling people for, say, their collection of premium, they don't like talking to human beings.
Okay.
You know why?
Oh, I don't
because
know
they think at the end of the conversation, you will always try and sell something to you.
And that I don't like.
Okay. That gave birth to a bot that we created. We call it Zara. Like US has this uncanny knack of naming all the bad things that happen on a woman. We said we should do differently. All the good things that we are doing, we should name on a woman.
Okay.
So she's called Zara. She will never sell anything to you. She'll only call you for what is required to be done by you with an inbuilt payment link platform where you can go complete your payment. She collected 1,000 crores of premium last year.
Wow.
One bot. Because she doesn't sell.
Sure.
Okay. And that is what some people don't like. So these are things which are of very, very large interest of mine. And that's something that...
I liked how you use that question, to talk about the insurance perspective. But it's very interesting, plant a tree, the nominee awareness and the bot. And I wish you all the best. I hope that you come back with some better new products whenever you have got them on Paisa Vaisa. But that is a wrap on this episode of Paisa Vaisa. My guest, Kamlesh Rao, MD and CEO, Aditya Birla Sun Life Insurance. Kamlesh, thank you for doing this for our listeners, and we look forward to having you back on our show.
My pleasure. Thank you for spending time with me. I was happy to speak to all your listeners. Thank you.
IVM.